Right then, good afternoon everyone, and just another update from us at the end of a pretty uneventful week when it comes to financial markets. We were pretty lacking in terms of data, in terms of fresh data out, certainly across the economic calendar and also across the various news sources as well. We'll start with the UK. Start with the UK. That was really the main focus of attention this week, was UK related assets, sterling and the FTSE in focus this week. And then we start on Tuesday with the unemployment rate. Unemployment rate actually ticked up slightly, so slightly negative in terms of unemployment. Goes with those stagflation fears. Couple that with the high inflation print that we had, the high CPI print then on Wednesday, right? Previously 10.1% for the month of September. Consensus was for 10.7%, so we were expecting an uptick in the CPI print over the course of the month of October in terms of the year-over-year figure. We actually came in 11.1, which is the highest rate of inflation, the highest CPI print in 41 years in this country. Right, now you'd expect that to have had a bit of an impact in markets, but didn't really have much of an impact. I mean, it does go with the stagflation thing, with higher levels of unemployment growing, higher levels of inflation. Many metrics suggest that this is the peak in inflation. We then had the autumn statement, which I'll get back to in a minute, which alluded to this potentially being a peak in inflation. We've had some commentary out of some Bank of England members saying that probably will be the peak in inflation, but it's slightly higher than the central bank's forecast going back a number of months. Couple that with retail sales, which is slightly strong, consumer spending in the wake of this cost of living crisis, which is a positive for the UK economy, but it is still only 0.6 print off the back of this minus 1.5 print over the month of September. But we'll come back to the statement, the UK autumn statement, or the new fiscal budget, whatever way you want to try and call it. The new Chancellor, Jeremy Hunt, came out and made some measures on how to plug a £50 billion hole in the economy, right? If you rewind then a couple of months with Liz Truss and Kwasi Kwarteng, they introduced a bunch of tax cuts that were going to cost the country 30 billion. It was like, how is this going to be funded? Nobody was really sure how it was going to be funded, and they've completely backtracked on all those measures, and now they have introduced £54 billion worth of tax raises, or along the lines of tax raises, and they're not all obviously due to taxes, but basically some of the main things that they focused on. I mean, they're focusing on growth. They want to focus on economic growth to try and grow the economy, just simply because we have got a recession. The Office for Budget Responsibility, the OBR in the UK, suggests that we are now already in recession. Obviously we need 2 consecutive quarters of negative growth in order to be able to confirm that, but the data does suggest, coming out of the UK at the moment, that we are in fact already in a recession. So measures have been taken in order to try and shorten the length of the recession and try ensure that the recession is not as deep as initially first feared. So the economy is due to shrink 1.4% next year. We're due to see a recession throughout the course of next year. These measures will then decide potentially how long that lasts. Now, there was a bunch of things that were made. The Chancellor announced a range of tax threshold freezes, including for income tax and inheritance tax, for further 2 years on top of an existing 4-year freeze until April 2028. Dividend taxes will be cut. Capital gains taxes will also be cut. So the tax-free allowance surrounding dividends and capital gains is reduced, so they will generate a bit more cash off the back of that. The threshold for the 45% additional rate of tax will be reduced from £150,000 a year, or the salary from £150,000 a year, down to £125,140, under £25,000. So more people are going to have to pay that higher rate in tax. And he made a comment, Jeremy Hunt, last weekend on Sky, I believe it was either Sky or BBC, I'm pretty sure it was Sky, last Sunday, that they were going to look to take money off people with the broadest shoulders, which I think is understandable considering the times that we're in with the cost of living crisis that we are experiencing throughout the country and throughout the world at the moment. Now, there was measures taken in order to be able to stem the cost of living crisis. The benefits, the measures that the government are taking in order to be able to give people support around the cost of living have been extended in terms of energy prices and that sort of stuff. help with the energy costs for different households has been extended past the April date that it was going to finish. Now it's a £2,500 annual limit for these costs. They're going to increase that to £3,000, so there's still a cap on it, but obviously had to raise, and that generates a bit more cash post the 31st of March, when that was due to end. Apart from that, there's a bunch of other things. Windfall taxes. When it comes to businesses, business rates are due to be kept low to help roughly about 700,000 businesses. If 700,000 businesses are being helped by their costs being capped or their costs being kept in check, that is obviously positive for businesses and positive obviously for the economy. Then off the back of that, they're going to do a bunch of different measures, including public spending. They're going to spend more money into the economy. In terms of education, they're going to increase education's budget. In terms of the NHS, they're going to increase the NHS's budget in order to help these certain sectors of the economy that were previously struggling. They're going to continue on with different things in terms of being able to innovate in terms of things like energy and infrastructure in order to a comment that he made, increase in terms of being able to make the UK, to make England the new Silicon Valley, as he was talking, in order to be more at the forefront in terms of innovation around energy and infrastructure. They're going to continue on with the new nuclear power plant at Sizewell C in order to have more sustainable energy and reliable low carbon power, in order to move away from producing energy from other parts of the world and kind of be more reliant on themselves. So a bunch of different things to help the economy. I'm not going to run through every single other thing. A bunch of other things will help. There's a lot of cost of living supports. The national living wage will rise by 9.7% next year, in order to be able to help people out. £10.42 an hour is what the national living wage is going to become next year, which will rise is just under 10%, nearly 10%. So there's been a lot of measures taken in order to try and support the economy, to try and help the kind of middle to lower class, taking money from the upper class and the kind of wealthy people of the country, to try and take a bit more money from them, give to the lower class, which is kind of all the hallmarks of a Labour government. All the hallmarks of a Labour government, which is obviously likely to cause some issues, I would imagine, in the Conservative Party, but we will leave that to them to argue and disagree on. And there's a bunch of all other stuff that they introduced in the article, but just to rattle off a few things there to give you an idea on what they decided to introduce. Now we'll flick across to the UK related assets. We'll look at sterling, cable, we'll look at the FTSE, and that's just pretty sideways. A lot of this was in line with market expectations, so it's not a surprise one way or the other. We looked at the dollar index, the US dollar, just choppy sideways for the whole course of this week. We look at the S&P, which is choppy sideways throughout the course of this week. Now we did have big massive moves off last week's CPI print, so when we come into this week, when we had massive moves off the CPI print last week, massive dollar downside, massive stock index upside, it's probably to be expected that we end up with a slightly range bound market this week, and markets have not traded well by any stretch of the imagination over the course of this week. So it's been a little bit difficult in terms of making some profits on the main assets that are usually traded by people. So if you weren't able to make some cash this week, don't get too annoyed, don't beat yourself up. Whatever chart you look at, pretty difficult to find some trading opportunities on this week, and these weeks happen. You can't have 52 weeks of the year trading well when you get such high levels of volatility and such good opportunities to make cash as we did last week with that CPI print. When you can take advantage of something like that last week, you're happy to sit there for a week and not do much trading. That's just the way trading goes, unfortunately. I don't want to go flicking through a load of different assets at the moment, as this week has not been good for trading conditions. We'll flick on to next week, and next week doesn't get much better in terms of the news flow. We can see all the high impact data. Really all we've got the FOMC minutes next week. We might get an indication of where they think interest rates will go, and we might get an indication of where they will finish. We might get a more clear cut answer of of how high the rate hike is going to be. Markets think 50 basis points in December. That is what markets are currently pricing in. We've had upgrades from Goldman Sachs in terms of their their target terminal federal funds rate. We've had comments out from a number of Fed speakers that have agreed with Goldman Sachs's terminal rate for the federal funds rate of a range between 5% and 5.25%. So still got a fair bit to go in terms of rate hikes. Still, the US have got a fair bit to do in terms of cooling down economy. So yeah, there's still a fair bit to do in terms of that. I don't know why this calendar doesn't have a high impact, but we'll just flick down to Wednesday morning. We've got the RB&Z out with another interest rate hike of 75 basis points. Now, we got a 50 basis point at the last one. They did mull a 75 basis point hike in their statement. Going back to their last meeting, they did want the 75 basis point hike, or some members did want the 75 basis point hike, but they did go with that 50, so we're expecting a 75 at this meeting. You'd have to imagine then if it go with 75, it's probably likely to be met with some dovish commentary, as they are the leaders in terms of interest rate hikes. If they get up to 4.25%, they will be the highest interest rates in the G8 economy. So, does that mean some Kiwi upside between now and then? I'm not so sure. We're expecting it. They've hiked rates with dovish commentary the whole way through, so I don't know. Personally, I'm a bit bereft of ideas, if I'm being perfectly honest. We've not got a great deal out next week. We'll have to look towards our cross-asset correlations, towards our technical levels, in order to guide us through trading next week, as we are not getting much. We're not getting much in the way of fresh data. Back to cryptos again. Sorry, just before I wrap this up, forgot to mention it. Cryptocurrencies have had a little bounce back this week. If I just get back, I'm gonna get some Bitcoin up. We'll get this up on the chart. These are the lows then printed last week. We have a slight bit of a bounce back, a bit of stabilization in the cryptocurrency markets, but no real progress either way at all. FTX, Sam Bankman-Fried said he regrets filing for bankruptcy in terms of FTX, what they did last week, but we've not had really much of an update on where to go from then and where the money has gone. We are expecting some investigations by the US government into FTX and the conduct they've gone about over the last number of weeks and months, and probably years, considering what they've done. But spoke a lot about that last week. We have a couple of articles on City AM, done a bit for radio stations this week on the cryptocurrency situation. So not a great deal of information, fresh information out towards the back end of this week. But anyways, just gonna wrap it up there then, folks. I'll let you get on with your afternoons. I'll let you get on with your weekends. Pretty difficult trading conditions this week. Pretty bereft of ideas personally, in terms of where to take markets from here. It's a little bit tricky to navigate. But anyways then, folks, I'm gonna wrap it up there then. Have a nice weekend, and I will speak to you all again next week. Have a good one.